Most financial advisors talk endlessly about retirement accounts, stock portfolios, and real estate investments. They emphasize budgeting, cutting expenses, and maximizing returns on capital. But there's one wealth-building strategy that rarely gets the spotlight it deserves, and it might be the most powerful one of all. It's not about where you put your money. It's about investing in something that can generate money for decades to come. That something is you. The concept is called human capital, and it represents the present value of all the income you'll earn throughout your lifetime. Think of it this way: when financial planners calculate net worth, they typically add up assets like savings accounts, investment portfolios, and property values. But they almost always ignore the biggest asset most people will ever own, which is their ability to earn money. For someone in their 20s or 30s, human capital can be worth millions of dollars. A person earning $50,000 a year over a 40-year career will generate $2 million in gross income. Someone earning $100,000 annually will produce $4 million. Yet most people treat this massive asset as if it doesn't exist. Here's where it gets interesting. Unlike financial investments, which are subject to market fluctuations and diminishing returns, human capital can actually grow exponentially through strategic investment. Every new skill acquired, every certification earned, and every connection made has the potential to multiply earning power for years or even decades. The mathematics behind this are compelling. If that investment leads to a salary increase of just $5,000 per year, and you work for another 20 years, that's $100,000 in additional lifetime earnings. That's a 10-to-1 return, far exceeding what most stock market investments deliver. Financial gurus rarely discuss this strategy for a few key reasons. First, it's harder to sell. There's no fund to buy into, no portfolio to manage, and no commission to collect. It requires individuals to take personal responsibility for their growth, which doesn't fit neatly into the financial services business model. Second, the returns aren't easily measured or guaranteed in the short term. Investing in a certification program or an advanced degree doesn't immediately show up on a balance sheet the way purchasing stocks does. It requires faith in future outcomes and a willingness to delay gratification. Third, it challenges the conventional narrative that wealth is primarily about managing money rather than earning it. Consider the typical advice given to young professionals. They're told to maximize their retirement contributions, maintain an emergency fund, and invest in low-cost index funds. All of this is sound guidance, but it often comes at the expense of investing in career advancement. A 25-year-old contributing $500 monthly to a retirement account might be better served putting half that amount towards professional development, while still maintaining baseline savings. The difference in lifetime wealth accumulation could be staggering. Human capital investment takes many forms. Formal education like graduate degrees or professional certifications can open doors to higher-paying industries and positions. But the most effective investments are often more targeted. Learning high-demand technical skills like coding, data analysis, or digital marketing can transform earning potential in months rather than years. These skills are in constant demand across industries, and the barrier to entry is often lower than people assume. Online platforms offer comprehensive training programs for a fraction of what traditional education costs. Someone willing to dedicate evenings and weekends to skill acquisition can position themselves for significant salary increases within 6 months to a year. Beyond technical skills, soft skills like negotiation, public speaking, and leadership often deliver outsized returns. A professional who learns to negotiate effectively might secure an extra $10,000 in their next job offer. Over a career, that initial gain compounds through percentage-based raises and sets a higher baseline for all future earnings. Public speaking ability opens doors to consulting opportunities, board positions, and visibility within industries. These are the types of investments that pay dividends repeatedly throughout a career. Networking represents another form of human capital that's frequently undervalued. The relationships built through industry conferences, professional associations, and mentorship programs create opportunities that can't be accessed any other way. A single connection might lead to a job opportunity, a business partnership, or insider knowledge about emerging trends. These relationships become more valuable over time as both parties advance in their careers. Yet, people often hesitate to invest in networking because the returns aren't immediate or certain. There's also the entrepreneurial dimension of human capital. Skills and knowledge can be monetized directly through consulting, freelancing, or starting a business. A software developer who invests time learning a specialized technology can command premium rates as a consultant. A marketing professional who builds expertise in a specific industry can launch an agency serving that niche. These ventures not only generate additional income, but also diversify earnings beyond a single employer. This diversification is itself a form of risk management that traditional financial planning often overlooks. The timing of human capital investment matters enormously. Early career professionals have the most to gain because they have decades to capitalize on increased earnings. A 30-year-old who boosts their income by $20,000 through strategic skill development will earn hundreds of thousands more by retirement than they would have otherwise. The earlier these investments are made, the more time they have to compound through raises, promotions, and career transitions. Yet this is precisely when people often have the least discretionary income to invest in themselves. Breaking this cycle requires a shift in perspective, viewing education and skill development as investments rather than expenses changes the calculation. Taking on some debt for a high-return professional certification makes financial sense when the payback period is measured in months, not decades. Protection of human capital is equally important, but rarely discussed. Younger workers often have substantial earnings potential but limited financial assets. Their priority should be protecting their ability to earn through disability insurance and maintaining their health. An injury or illness that prevents someone from working in their 30s or 40s doesn't just eliminate current income, it erases decades of potential future earnings. Yet, disability insurance is often viewed as an afterthought compared to life insurance or property insurance. Similarly, investing in physical and mental health through exercise, nutrition, and stress management protects the capacity to earn over a full career. The concept of human capital also reframes common financial decisions. Career changes that involve temporary income reductions might make sense if they build valuable skills or position someone in a growth industry. Geographic moves to higher-cost areas could be justified by access to better career opportunities and higher salaries. These decisions look risky when evaluated purely through a traditional financial lens, but they often make perfect sense when human capital is factored into the equation. There are, of course, limitations and risks. Not all educational investments deliver positive returns. Graduate degrees in oversaturated fields or certifications in declining industries can be money losers. This is where research and strategic thinking become crucial. Understanding which skills are in demand, which industries are growing, and where one's natural talents align with market needs determines success. It's not enough to simply invest in oneself. The investment must be targeted and informed by market realities. There's also the risk of over-specialization. Investing heavily in skills that become obsolete due to technology or changing market conditions can be devastating. This makes continuous learning and adaptation essential. The professionals who thrive over decades aren't those who mastered one skill set and stopped. They're the ones who continuously evolve, adding new capabilities and pivoting as industries transform. This requires viewing human capital investment not as a one-time event, but as an ongoing process throughout one's career. The strategy becomes even more powerful when combined with traditional financial planning. Building human capital creates the income to fund investment portfolios. Those investment portfolios then provide security and flexibility to take calculated career risks. It's a reinforcing cycle where each element supports the others. Someone with a robust emergency fund and some passive income from investments can afford to leave a dead-end job for a better opportunity or take time to retrain in a new field. Their financial capital supports the growth of their human capital, which in turn generates more financial capital. So why don't more financial gurus emphasize this approach? Part of the answer lies in the structure of the financial services industry. Advisors are compensated for managing assets,